All right, everybody, unless you were living under a rock this weekend, you probably realized that Trump did, in fact, put the 25% tariff in place on pretty much all Canadian goods. 25% to most everything, 10% to energy. And a lot of people, there was a lot of rumors that Trump was possibly going to delay this. When he first got elected, it was supposed to be a day one thing. He delayed it to February 1st. Then there was actual rumors that he was going to delay it to March 1st. And then that quickly changed, and he said, nope, they're going in February 1st. So we're now sitting here on a Monday open with a lot of Canadian stocks down quite a bit that are exposed to these potential tariffs. Now, for the most part, even I would have figured the market probably would have priced most of this in beforehand, because a lot of this was well known. I mean, it was in his campaigns. It was fairly obvious that it was going to happen. So I didn't think stocks would take this big of a hit. But we're sitting here today with the Canadian railways. We're looking at Canadian National Railway down 4%, and we're looking at CP down nearly 7%. So CP's larger drawdown is likely due to the fact it has, railways across Mexico, Canada, US. It's probably a little more exposed to tariffs than CN Rail is, but make no mistake about it, both of these companies are very, very exposed to tariffs. So I'm going to go over both of these companies' results in this video. I'm going to discuss the tariffs, the potential impacts, my overall thoughts on the tariffs, things like that. So let's get right into the video. But the first thing I do want to say is down in the description, I put out a comprehensive report on a stock I'm probably going to be pulling the trigger on this week, either this week or next week. I might let things settle down due to the overall volatility right now, but if you want that report, it's absolutely free in the description below. It's a report that we sent out to premium subscribers, but I made it free for everybody just to thank you for being a loyal reader, a loyal subscriber. So head down to the description below, get that for free. And as always, everybody, like the video, subscribe to the channel. So tariffs, just a quick explanation on what tariffs exactly are. Pretty much in a nutshell, it's to encourage domestic production. So Trump is initiating these tariffs so that more US companies buy US domestic goods instead of, relying on, say, Canada to ship their auto parts, Canada to ship their, say, softwood lumber. They're going to apply a tariff so that US producers have to pay in order to buy Canadian goods. And what the end result for this is, I'm not exactly sure what Trump's end goal is here, whether it be to collect enough revenue from tariffs that he can lower taxes for U.S. consumers, whether it just be a negotiation tactic to get some concessions for, U.S. businesses to maybe enter the Canadian market. We saw him say yesterday that he is kind of angry that Canada does not let U.S. banks operate here in Canada. Highly regulated industry. Obviously, we got the big five banks. He said it's kind of ridiculous that they won't let those enter. So who knows that, maybe during the negotiation process, there's some concessions made where some U.S. banks can enter Canada, maybe some U.S. telecom companies, maybe U.S. dairy, things like that. So the end goal of his is relatively unknown. I know he did mention that it is the border, the fentanyl, the immigrants coming through, the illegal immigrants coming through the border. I don't really think that this is the reason. I think this is just a convenient excuse for him to implement these tariffs. Pretty much, why do I think this? Well, when they asked him, how the tariffs could be removed, he pretty much said there's no way they can be removed now. So this kind of leads me to believe that, even if the border was fixed, he really wouldn't do anything about it. But let's get into CP Rail and CN Rail. And the first thing I want to do is go over their quarterly results. I'm not going to spend a ton of time on this because I do want to get into the potential impacts of the tariffs. But when we look to CN Rail, they actually reported a relatively soft quarter, I would say. We look at revenue ton miles, they were down 3%. We look at revenues down 3%. We look at pretty much, most segments, forest products, fertilizers, automotive was flat, grain was flat, coal was flat, metals were flat. This is primarily a result of just kind of a, tough economy. Carloads are struggling. They're declining. We look at Q4 operating income. It's down 10%. Their operating ratio increased with railways. We want to see this decrease. The lower the operating ratio, the better. And what this effectively does is compares the operating expenses of the railway to the revenue it generates. So what this is effectively saying is CN Rail needs to spend $62.60 for every $100 in revenue they generate. It's kind of a reverse operating margin. When we look to earnings, they're down 10%. And the interesting thing about this is CN Rail buys back a lot of shares. So they're buying back a ton of shares, which ultimately is going to shore up earnings per share, whereas, it's still falling. So they're buying back quite a bit of shares. I've been overly critical of the company in terms of their share buybacks instead of debt repayments, whereas a company like CP is really prioritizing debt repayment over dividend raises over share buybacks. I'm a big fan of that. I actually ended up selling my CN Rail and buying CP just because I believe CP is the better operated railway at this point in time. But when we look to their financial outlook, they expect to deliver 10 to 15% adjusted earnings growth over 2024. And then I believe they don't have this here, but they expect by the end of 2026 to achieve a high single-digit compound annual growth rate on earnings. So what that tells me is they expect a little bit better growth next year and then maybe a bit of a slowdown. Now, they raised the dividend 5% on the quarter, and this is actually the lowest dividend growth rate that CN Rail has raised the dividend in quite some time. So this is kind of an indicator of, the fairly rough economy, the rough results. We're looking at a debt to adjusted EBITDA target of 2.5x. CP Rail sits at around 3.4x. So it is better from a leverage standpoint than CP Rail. But the thing is CP Rail is highly leveraged because of the Kansas City Southern acquisition. So that is primarily why you're seeing this lower debt ratio. CP has improved that debt ratio and continues to improve it just because of the difference in strategies. CN Rail, heavy buybacks, dividend growth. CP Rail is pretty much pure debt repayments at this point in time. So overall, CN had a relatively rough quarter overall. It wasn't really all that good. I mean, we look at free cash flow down 20%. We look at returns on invested capital, they're falling as well. There's really nothing that CN Rail can do about this. I mean, it's just a state of the economy. Would I like them to allocate a bit more towards debt repayments instead of buybacks and dividend growth? Yes, but ultimately they've done this for a long time. They'll probably continue to do it. But overall, I didn't really like the quarter from CN. I did like the quarter from CP Rail. So when we look to CP Rail's quarter, we're looking at adjusted combined diluted earnings, which the reason they're saying combined is because it combines the Kansas City Southern acquisition. We are getting to a point where year-over-year results are now reflecting the acquisition in the business. Last year, we had a bunch of crazy adjusted results because the year prior, the Kansas City acquisition was not factored in. So you were seeing crazy high revenue growth rates, but when you adjusted it out, it really wasn't that high. But now we're kind of getting more normalized results. And the thing about it is the company is reporting 9% earnings growth, but they're not buying back a lot of shares. If we look to the overall buybacks from both of these companies, we can see that CN Rail has been a substantial, they've been buying back a ton of shares. 2022 started, they've been buying back a boatload of shares, 700 million down to about 627. Whereas CP Rail, we can see a big share issuance here because of the acquisition, and then it stayed relatively steady. So the fact that CP has been able to grow earnings by 9%, not buying back any shares, is kind of a testament to the fact that the internal business, the core operations, are probably doing quite a bit better. We look to the operating ratios on a quarterly basis. They came in pretty strong. When we look at the full year, they're pretty much in line with CN Rail. A little bit worse, but not overly concerning. And again, when we adjust those earnings out throughout the whole year, they grew by 11%. And CP Rail's guidance was a lot more bullish. They're expecting 12 to 18% in earnings per share growth, whereas CN Rail was that 10 to 15%. And again, the buybacks, they do impact this because CP Rail is not buying back any shares, whereas CN Rail is. So I do believe that CP Rail's guidance was a lot better than CN Rail. And the one thing is the efficiency of CP is much better at this point in time. We're looking at, a 4% improvement in average train weight. We're looking at a 4% improvement in train length. We're looking at a 1% improvement in overall productivity. And we're looking at a 2% improvement in fuel efficiency. So for CP, the trains are getting heavier, the train lengths are getting longer, yet the fuel mileage is improving. So these are all positive signs for the company overall that kind of, the economy is going to impact the company's results no matter what. They can't really do anything about this, but what they can do, make things a little more efficient operationally. And when we look to CN Rail, they actually reported declines, low single-digit declines, nothing overly concerning across pretty much every end of these efficiencies. So overall, it was a relatively soft quarter from both railways, but I do believe CP Rail actually reported the better quarter. But the one thing I want to do is go over the potential tariff impact. So when we think about what is being tariffed heavily and what is going to impact these companies the most, they're pretty much, they touch every segment of the economy. I mean, we look at petro and chemical, we look at metals and mining, forest products, coal, grain and fertilizers, intermodal, automotive. Every single element of the economy runs through these railways. But the one thing I want to highlight is when we look to total freight revenue per carload, which is effectively the revenue that the company generates per carload of freight. We see the highest one is forest products. We see the second highest is grain and fertilizer. We see the third highest is petro and oil. And we see the fourth highest is automotive. And when we look to Canadian Pacific, Kansas City, it's much the same. We see that automotive is up there. We see that forest products is up there. And we see that grain is up there quite a bit as well. So I want to show you an article that kind of goes over the potential impact of the auto tariffs. So car buyers and auto workers in Southern Ontario may be among the first to feel the pain of new 25% tariffs. So from what I'm getting from this, auto parts and auto manufacturing need to cross the border numerous times. And what I'm kind of reading about this is the fact that Trump has pretty much stated that the situation will require a 25% tariff each time these vehicles, automotive parts cross the border. So right here is a very important thing to understand is the tariffs may add thousands of dollars to the cost American businesses trying to buy Canada's second biggest export, the auto industry says. Canada is exposed to the shocks of the auto sector because Ontario is the only place in North America where 5 major automakers manufacture. So that requires sending auto parts back and forth across the border, sometimes multiple times. So there is the potential for these automotive companies to be hit multiple times across the border for, what they would not have been hit a single time even a couple of days ago. So this article actually figures that tariffs will shut down the North American auto production within a week. And when you think of these two companies, this is one of their highest revenue per carload segments, the automobile. I mean, it's not the most profitable, but it is certainly one of the main drivers of the company. I mean, when we look to overall shipments, it's actually a big chunk of the business. And if this shuts down the automobile industry and causes, wide-scale layoffs in that regard, these companies will be hit quite a bit. And I do think that's why you see these railways trading quite a bit down this morning. So the final thing I want to go over is whether or not these railways are possible buys right now. And I mean, I guess, spoiler alert, yes, I do think they are. I actually ended up adding CP Rail recently. When we looked at current valuations, we look at CN Rail trading at around 21 times earnings. 5-year median averages are around 21.3. And when we look to CP, they're trading at 27, where their historical averages is 24.8. So CP Rail is definitely the more expensive company when you look at it on the surface, but there's a few reasons why this is likely a bit inflated. First off, they had a lot of one-time costs last year in regards to the Kansas City Southern acquisition. It caused a lot of one-time costs, and in addition to this, the market is likely willing to pay a bit more for CP Rail right now just due to that earnings guidance and the fact that they have the tailwinds from that Kansas City Southern acquisition. So I do believe that this is a relatively fair price. I do expect these earnings to normalize. When we look on a forward basis, we can actually see that CN Rail 16.29 expected earnings, whereas CP is 19. So CP again is a little more expensive. And when we look to a PEG of 0.98, whereas CP Rail, we're looking at 1.258. This is a element of, again, I guess I should go over the PEG. First off, you want to see a number under 1. That kind of gives a bit of a suggestion that the market is probably not valuing the forward growth of the company. So from a PEG standpoint, CP looks a little more attractive at this point in time. There's a few reasons I do like CP, even though it's a bit more expensive. First off, as I mentioned, that Kansas City Southern growth potential. And then we look to just the prioritization of capital at this point in time. Again, buybacks and dividend growth from CN Rail, where CP is really prioritizing that debt reduction. If we go to leverage ratios from CP, we're looking at 3.4 at the end of 2023, and we're looking at 3.1. This would be their debt to adjusted EBITDA. So they're reducing that leverage ratio. They reduced it by, what would this be, 9%, probably 8-9% last year. They're going to continue to do that moving forward. They're not going to be buying back shares. They're not going to be raising the dividend. I'm completely fine with that. Ultimately, the quicker they pay off that debt when it comes to the Kansas City Southern acquisition, the quicker they can start to realize the benefits from that. We're looking to, CP's Rail's balance sheet is perfectly fine. Debt to equity of 0.47. They have a 7x interest coverage ratio. Whereas we come down to CN Rail, they have a higher debt to equity. Obviously, they have not generated as much shareholder equity relative to their debt. So they do carry a little bit more debt on the balance sheet than I'm comfortable with. But again, CN Rail is fine. I mean, we're looking at interest coverage ratios of 7.5x. They're very comfortable from that regard. I would just, probably have liked it if they probably allocated a bit more of that free cash flow towards debt. Again, the dividend is well covered. It comes in at around 67% of free cash flow. So there's no fears of dividend decline here. But overall, I do like CP. I own CP. I paid a more expensive price on CP. But I do like the network, the more diversified network. I like the fact that they, that Kansas City Southern acquisition, the quicker they get that debt level down, the quicker that's going to materialize in terms of higher earnings. And then when the leverage ratios get down to a more comfortable level, I do believe that is when CP will start buying back shares. They'll start reducing that share count. They'll start raising the dividend. And it's ultimately going to fuel a bit more tailwinds. Now, there's no doubt that these railways will face continued pressure if tariffs continue. Ultimately, that automobile sector, who knows in regards to how Canada will counteract this if they kind of issue export tariffs on, say, chemicals. I know it's been rumored that there is the potential to export tariff potash because Canada is a very big supplier of potash to the United States. And they're actually, I believe it is Canada and Russia are the two biggest exporters of potash. And when you think about it, I really don't think the US is going to be too happy if Canada export tariffs the potash and they're forced to buy it from a country like Russia. So that's possibly something that Canada has in their back pocket, which again would probably hit these railways in terms of overall shipments. Yet again, they're probably the most exposed companies in the country when it comes to tariffs. And as a result, we're seeing, a bit of sell-offs, which is, it's to be expected. Again, it's larger than I expected because I would have expected the market to, probably price this in because they knew it was going to happen beforehand. But I think this element of the automobile sector, the multiple tariffs, the fact that the automobile sector is going to shut down, and overall, I continue to buy the railways for the long term. Can they be impacted? I mean, if these tariffs last 6 months, if they last a year, I don't really expect any sort of material rebound in price. I mean, the market sentiment is going to remain pretty low on stocks that are already pretty low. But I do believe that these are some of the best, the highest quality companies in the country, and I don't really think you can go wrong owning these. Railways are going to be utilized for a very long time to ship goods countrywide, and I do think that the US and Canada and Mexico are going to come to some sort of conclusion to all of this, whether Canada gets the harsh end of the stick out of it, whether they have to open up a lot of concessions for U.S. competitors to enter the country, fix the border, things like that. But ultimately, I do think this will end. And when it does, I do believe that buying the railways at these times will prove to be beneficial. So everybody, that's it for the video. Hope you liked it. Head down below, grab that free research report on a stock I'm going to be pulling the trigger on either this week or next week. And again, like the video, subscribe to the channel, and stay tuned for more great Canadian content.